clients, welcome to this week's Market Watch. I'm Nicholas Ong, investment analyst from Phillip Securities Research. Today, I'm going to share with you the OMM outlook. According to DNB Markets, investments in offshore E&P operations and projects will grow by 8% year-on-year to $632 billion in 2013, from $585 billion last year, with a forecasted 10% of industry spending directed towards exploration drilling projects, coupled with oil prices hovering above $100 per barrel. We remain positive on the offshore marine sector. Furthermore, investment in ultra-deepwater projects is expected to increase by more than 50% through 2015 due to the growing need to exploit reserves from deeper waters. On the shallow water side, there are at least 70 jackup rigs to be built by 2015, but about 50 are still uncontracted currently. Although we expect the pace of jackup rig orders wins to tone down this year, the market for high-spec jackup rigs remain positive, with companies like Seadrill and Transocean still expecting steady demand for premium standard jackups from Asia and the Middle East. We continue to see differentiation in the jackup market, with newer units having utilization rates and day rates exceeding those units that entered service before year 2000. We estimate that about 57% of the existing fleet is more than 25 years old, assuming the average life of a jackup at around 25 to 30 years old. This reflects significant potential for replacement in the coming years. According to EIA, energy supply from ultra-deepwater sources will account for more than 10% of global oil consumption in the next few years, up from 8.5% in 2010. We believe the ultra-deepwater rig demand outlook remains positive as deepwater momentum continues to grow. Of the 13 semi-subs scheduled for delivery by 2015, merely 5 are uncontracted. The day rates for ultra-deepwater rigs remain around record highs, and utilization rate stays above 95%, indicating tightness in rig supply. According to Douglas Westwood, a total of $223 billion in capex will be spent on the deepwater segment till 2017, with $78 billion on drilling and completion of subsea wells. For FPSO, demand outlook appears positive, as the numbers continue to grow with the increase in deepwater exploration. Most deepwater oil fields would not be commercially feasible without the use of these floaters. According to BP, order demand for deepwater production facilities should reach 22 units in this year, following 15 units ordered in 2012. This, in turn, would trigger a need for additional floating production systems and ensure healthy growth in orders going forward. We believe the forecast expenditure numbers for the FPS segment as a whole are huge. According to Douglas Westwood, a total of $91 billion in capex will be spent on these systems till 2017, with FPSOs accounting for 80% of total capex. And an up-and-coming type of floater, called floating LNG, or FLNG in short, is used in the production and processing of natural gas at offshore fields itself. Like FPSO, which is designed for the production of oil, FLNG enables the substitution of fixed pipelines and traditional on-land plants, hence providing for lesser capex requirement than onshore developments, as well as greater mobility for field development even in previously unviable locations. Asia is expected to account for 32% of global FLNG capex of $38 billion till 2018. We could see yachts like Keppel and Samsung, which have a head start in FLNG projects, to benefit from this new and growing segment. I believe rig builders like Keppel and Sembcorp Marine will continue to benefit from the positive O&M outlook, particularly in the ultra-deepwater segment. In fact, Keppel remains our top pick for this sector. Here's our analysis on why we prefer Keppel over Sembcorp Marine. Sembcorp Marine saw a big jump in its order book by 150% in 2012, which in turn will result in robust revenue earnings growth over the next few years. In our opinion, this could be as high as 14% earnings CAGR from 2012 to 2014, versus a slight increase of 2% for Keppel over the same period. We believe Keppel's earnings growth will be much lower, as its already high order book merely grew by 37% last year. However, we think Sembcorp Marine's stronger earnings growth profile, due to its record order book, are largely priced in by now. Secondly, Sembcorp Marine saw a change in its product mix with a breakthrough into the lucrative drillship market last year via 7 orders from Brazil. This makes Sembcorp Marine's order book more balanced, and we view this positively as it allows Sembcorp Marine to build up a position in the drillship market, given that the Korean yards has always dominated this market. Nonetheless, it seems that Sembcorp Marine may have to pay learning curve tuition fees for this relatively new type of product segment, especially since it is a new entrant in drillships and has yet to establish a track record. This is reflected in Sembcorp Marine's lower fourth quarter EBIT margins of 10.8% versus 14.1% in the third quarter last year, which according to management is partly due to the conservative margin recognition for the first 20% of the drill ship. We expect this conservative recognition to continue to pressurize margins over the next 2 years. On the other hand, product mix of Keppel has remained relatively constant over the years. Thirdly, we note the designs of rigs constructed by both Singapore yards and believe that Keppel has an edge over Sembcorp Marine, as Keppel's order book concentrates mostly in jackups and predominantly based on its proprietary KF-ELS B-class family designs. In fact, of the 29 jackup rigs to be built by 2015, 19 are constructed to its B-class designs. Thus, we believe Keppel will be able to leverage on the repeated delivery of its proprietary design, while Sembcorp Marine's diversification into drill ships and jackups based on F&G designs may weigh on its margins. Next, Keppel is expected to deliver a record number of jackup rigs in this year, and we believe the economics of scale from its 15 KF-ELS B-class series design this year could lead to positive margin surprise. In view of this, we think Keppel's O&M EBIT margins could rise in 2013. On the other hand, we think that Sembcorp Marine's EBIT margin will still be under pressure in the next 2 years, as it undergoes learning curve for new products, in particular its 7 drill ships for Brazil. Last but not least, dividend. Despite Sembcorp Marine's strong financial position with net cash position of 1.1 billion in end of 2012, special dividend dropped by 85% to 2 cents per share in 2012, taking the total dividend declared to 13 cents per share versus 25 cents per share in 2011. This is mainly due to the increase in capex spending for the new yachts in Brazil and Singapore. We expect capex spending to stay high in 2013, hence special dividend will remain low, and with a forecast dividend payout ratio of 45 to 50%, we are looking at dividend yield of merely 3% in FY13. Meanwhile, Keppel's stable dividend payout ratio of 50% should help dividend yields to remain strong at 4% in our view. That's all for this week. See you again.